a trading week dictated by off-calendar events as much as on, Commerzbank's Peter Kinsella is on the phone with me now to take a closer look at the week ending 12th of July. Peter, what for you has been the market-moving item of the week?
Without a doubt, it's been Ben Bernanke's speech on Tuesday and Wednesday this week, where basically he, let's say, took the market completely by surprise, basically in his outlook for U.S. monetary policy development, saying that very, very accommodative policy is going to be required for quite a considerable amount of time. So this basically set the market in thrall. You've seen the dollar weaken quite considerably. Your dollar went from around 128 back up to 132, and that has since kind of traded down to around 130.50. So it's definitely been quite a volatile week. You've also seen U.S. Treasuries trade from around 275 basis points right back down to sort of 257 or thereabouts. So it's been a choppy week both in the rates markets and in the FX market.
You mentioned there already Ben Bernanke's comments, and markets do seem to keep reacting to these discussions surrounding tapering. But with these remarks based on signs of economic recovery within the US, why such pessimism regarding tapering? Is it because markets see a chasm developing between the US and other global economies?
That could be part of it. I mean, I think it's basically that markets have become used to having, let's say, a policy of very easy liquidity conditions, both in the US and elsewhere. And really what you're seeing here is sort of this on-off communications from the Fed, where one stage they're saying, yes, we're going to taper, then another stage they're saying, no, we're not. I mean, the point here, from a longer-term investor's point of view, is that these are very, very good developments, because if they're removing tapering, and if they're if they're going to taper and then eventually cease and then remove liquidity from the market, this is an indication that things are actually getting better, i.e. less unemployment, therefore more spending. So basically what you're seeing is kind of the volatility you're seeing is really just sort of what happens when you get a regime change in financial markets, and that's really what you're seeing at the moment. So I think that you're probably right. Without a doubt, there is too much pessimism, no doubt about that. But to my mind, the conditions for, let's say, a stronger dollar and a stronger U.S. recovery are very much in place. So most of the clever investors are kind of using any of these spikes in sort of euro dollar or other crosses basically to initiate or add to some of their long dollar position.
This was also the week that Australian unemployment hit a 4-year high. Newly installed Prime Minister Kevin Rudd commented on Thursday that relying on the lower dollar alone to boost competitiveness is insufficient for the great economic task that lies ahead. Has emphasis on Aussie dollar performance been overstated, do you think?
I don't. I think there's 2 points here. The first is that the Aussie dollar is trading at a very, very expensive level still, even after its fall from around 101, 103 towards current levels around 90. The fall isn't overdone. You've got to realize Aussie is trading at a very expensive level, mostly because of this sort of capex story in mining and the commodity story, etc. That's changing now, and certainly when you see China and you see many other emerging markets growing at a substantially slower pace than they have heretofore, basically the argument in favor of significantly stronger commodity prices is really no longer valid. That being the case, what you're seeing is that Aussie is basically losing ground, both from that sort of capex mining story, but also from the perspective of a simply lower rate profile. So I don't think that the pessimism is overdone on the Aussie by any means. If anything, people are still a little bit too sanguine about the risks that the Aussie faces. Longer term, we still could be going towards 85, even 82 in Aussie dollar, probably or even possibly within the next 6 to 12 months.
The Bank of Japan yesterday indicated to signs of recovery within the Japanese economy for the first time since 2011. The bank is to stick to its plan of pumping more than 60 trillion yen a year into the economy. Will that be it for Urbanomics for the time being, or can we anticipate further stimulus measures in the medium term?
This is really dependent on what's happening in emerging markets, believe it or not. The two strengths of this. The first is that what you've seen so far is that Abenomics has basically been a great sort of reflationary trade. So they're trying to talk up inflation expectations, and with that, you've seen that the yen has weakened considerably. Fine. The question is, where do we go from here? 2 points to say, really. The first is that if you look at the slowdown in emerging market economies, particularly within China, that's going to basically impact upon what happens in Japan, because Japan trades very, very significantly with emerging markets. It's in that part of the world. If anything, probably they trade close to between 30 and 40% of all Japanese exports go towards emerging markets. So if you see this slowdown happen at a greater or more fast pace, what that means is that the Japanese might actually have to inject even more stimulus into their own economy, be that fiscal or even more monetary easing. So for me, really, the trend is quite clear in terms of a weaker yen. You're going to see a weaker yen both for idiosyncratic reasons, but also if you see sort of a global recovery or in particular a recovery in the United States, that's really telling you that the yen's going to weaken even further, because as global interest rates start to rise, the yen, the Japanese can't really increase their own interest rates for obvious reasons, given their debt burden. So really what that's telling is that we've seen sort of, let's say, a brief period of yen weakness, but it's by no means finished yet.
And so on to next week. And what would you advise Dukascopy TV viewers to watch out for?
I think what you've got to watch out for this coming week is really what's happening in the Eurozone. If you've noticed, we're getting once again political sort of noise from Southern Europe, both in Spain and Italy, with various political scandals, and the rates market's already starting to react a little bit. You've seen obviously both Spanish and Italian bond markets start to react to this. So if you look at it, the market really has been somewhat myopic in the sense that they've just been looking at dollar-centric or US-centric events. They've kind of ignored what's happening in the Eurozone for quite some time. So should we see these sort of pressures resurface once again, that could be a burden for the euro, and it could be a burden for the European stocks.
Peter, many thanks for your comments. From all here at Dukascopy TV, it's goodbye for now and have a great weekend.